Morning, everyone. I think because now it's 10 o'clock and starts our session. Santosh, can you just confirm if you can hear me loud and clear? Santosh, can you hear me?
Yes, we can hear you. Thank you,
Okay.
Callan.
Thank you. Thank you so much. Yes, so good morning, everyone, again, and welcome to our part 2 of our Turbine Talks webinar series, where we're basically looking at legal, commercial, and contractual strategies for bankable wind projects. My name is Talent Duma, and I will be your moderator for this session, and it's a pleasure to moderate the session for today. And before we start, I would like to thank all our SAWEA members, our partners, as well as stakeholders, as well as our audience that are joining us online. And whether you are participating with us for the first time or if you've joined us before in our previous session, it's good to have you. And your engagement will be greatly valued as we continue with today's session. And then for some housekeeping rules before we begin, with our first speaker, I would just like to highlight a few things so that all the audience, may you please keep your microphones muted during presentations. And then also you are welcome to submit any questions via our Q&A tab and also be able to indicate also which speaker you are directing your questions to. Today we have our wonderful 2 speakers, and then we'll be able to address all the questions during our Q&A session right at the end, where my colleague Santosh will be handling that session. And then also lastly, this session is being recorded, and both the recording and the presentations from our speakers will be shared by all to all attendees at the end of our series. For some context, in South Africa right now, the wind energy sector is entering a phase where success is no longer determined solely by securing projects or achieving financial close. Increasingly enough, project outcomes depend on how effectively developments are managed through the transition from contract execution to construction, commissioning, and also operational delivery. So now, as the industry grows in scale as well as complexities, stakeholders are navigating a landscape shaped by either tighter project timelines, execution pressures, supply chain and infrastructure constraints, and the need to ensure that projects are delivered on time, within budgets, and to the standard that is expected by investors, lenders, as well as off-takers. So now, colleagues, the journey from concept to closure really does involve multiple interconnected phases where decisions made early in the contract and project planning can significantly impact or have implications for construction performance, commissioning, as well as long-term asset success. So now today's discussion forms part of the Concept to Closure webinar series that is being facilitated and arranged by SAWEA, which focuses on specifically on the pathways from contract to commissioning. This is basically a session where we'd like to unpack either the commercial, legal, technical, or practical considerations that are normally required to move our projects from signed agreement to successful delivery as well as operation. Our previous part 1 of the webinar roughly covered early stages of project structuring, procurement and contracting considerations, investor and lender expectations, and the broader commercial framework that influences whether our projects ultimately achieve financial close as well as get to be delivered successfully. So today's session, like I mentioned, is strictly focusing on contract to commissioning, and we'll be deep diving on the information that's going to be shared by our wonderful speakers. And then also just a reminder that we will be having part 3 on the 26th of May 2026, which now will focusing on commissioning to closure, where we're basically looking at operations, the commissioning of our projects, as well as the future grid. And then now to introduce my first speaker, which is coming from Standard Bank. I'm pleased to introduce Callan Govender, and I will just briefly take you through her quick bio. Callan Govender is a Senior Vice President at Standard Bank, where she works in senior coverage for power and renewables. Prior to joining the sector coverage team earlier this year, she spent 10 years in Standard Bank's project finance, deal structuring, and execution projects across wind, solar, battery, gas, and other sectors. Her experience spans the structuring, financing, and execution of complex transactions involving independent power producers, infrastructure developers, as well as institutional stakeholders. Ms. Govender has developed practical insights into how large-scale infrastructure projects are structured, financed, and delivered, including the allocation of construction, operation, as well as commercial risk between the various parties involved. She has worked closely with sponsors, lenders, legal advisors, as well as technical teams across multiple transactions, and has seen firsthand how the energy sector in South Africa has evolved over the past decade. Ms. Govender is her particular interest is in the continued growth of renewable energy and the role it can play in improving energy security for our country and supporting long-term economic growth in the region. Ms. Govender, thank you so much for joining us today, and please share your screen. The floor is yours for the first presentation. Thank you.
Perfect. Thank you, Talent. Please let me know if you can see my screen.
Yes, we can. You can
Perfect.
Go ahead. Thank you.
Okay, great. So I'm going to present today on contractor performance and execution risk management. Perhaps not the most exciting subject matter, but as Callan says, very, very important. There's lots to discuss, and I'm going to focus on key aspects. Hopefully it won't be too long, and I'll try to keep it as interesting as possible. Okay, so financing structures and performance through construction to COD stability. Just generally, some of the structuring considerations one must bear in mind, which is quite important, is the nature of draw profiles and the compounded financing costs that come with it. One of the biggest risks during delays is not just time, it is the compounded financing cost that comes with it. Under fixed draw structures, debt may continue to be drawn even when construction progress slows, which effectively means that the project is paying interest on capital that is effectively sitting idle. And so this has an impact of eroding contingency buffers, impacting equity returns. So flexible draw mechanisms are very important to allow funding and drawdowns to follow actual construction progress. From a lender perspective, preserving liquidity during delays is seen as one of the key protections against distress. Then just on VAT facilities, specifically on large wind projects, VAT during construction can create a significant temporary cash requirement. And so a dedicated VAT facility is essentially a liquidity management tool that allows the project flexibility while it waits for VAT recoveries. Debt service reserve facilities. Traditionally, projects were required to reserve large amounts of cash locked away in reserve accounts during construction operations, but it's become quite common for facilities and guarantees to be issued rather, which helps reduce this trapped cash and impact on equity returns, while still providing the key lender protections. Contingency facilities, perhaps just to make the point that contingency is not there because lenders expect failure, rather it is there because construction uncertainty is unavoidable. Structuring a separate contingency facility creates an additional liquidity buffer for cost overruns, delays, and any unforeseen construction events. Then just on floating versus fixed interest rate exposure, The point is that hedging is not about eliminating risk completely. It's really about making cash flows predictable enough to service debt in the long term. And particularly in the construction period, you want to have a greater sense of certainty on projected financing costs. And so locking in a fully fixed interest rates can certainly assist in achieving this. And then just in summary on this specific topic, the point is that financing structures is not just about pricing optimization. It's really about preserving flexibility, liquidity, and completion certainty through periods of execution. Lender assessment of EPC versus multi-contracting and interface risk allocation. So just to mention, there are three things that lenders are super concerned on. The project's ability to, 1, achieve completion on time, 2, within budget, and 3, to the required technical standard. And just within the wind space in South Africa specifically, we see split EPC contracts becoming quite common, but this doesn't necessarily mean it should always be the default position. While split contracting does present pricing optimization versus a fully wrapped contracting structure, for example, as well as procurement flexibility, it certainly does introduce a level of interface risk, which needs to be managed closely. A cheaper contracting strategy can fast become quite expensive if delays persist. So then just to summarize again, key focus areas for lenders: time to completion and delay risk. Lenders will evaluate delay protections, LD regime, robustness of construction schedules, cost to complete risk. Particular attention is paid to contingency levels, interface management, and sponsor oversight are key. Quality and performance assurance. Has the project actually been delivered to the required specification? Contractor assessment. So I guess the point is lenders are really also financing the ability of contractors to deliver the project. And so particular attention is paid to the technical expertise of the contractor, the financial strength, the track record. And then just to note that an impressive international track record does not always automatically translate into successful execution in the local markets. Local logistics, labor dynamics, and coordination with Eskom matters enormously. The point is, local execution capability is just as important as other factors of consideration. And then just in summary, some of the standard security package features include your bonding, which are your advance payment bonds, performance bonds, warranty bonds, which cover to an extent the performance-related obligations of the contractor. But the point is, in summary, you could have a perfectly documented contract with all the bells and whistles, but the point is that the contract is only as strong as the party standing behind it. Okay, execution risk governance and lender oversight during construction. Construction risk is not static. It needs to be managed every single day. In South Africa, you could almost count the number of wind projects that has been fully delivered on schedule to COD. And this is not necessarily because projects were poorly structured. It's more because construction execution is inherently complex. And so this is why sponsor oversight in project governance is so important. Regardless of the strength of the contractor, the contracting strategy, be it split or fully wrapped, active sponsor oversight is still required. The sponsor team is really the central coordination party of all parties, including lenders, advisors, Eskom, etc. When issues arise, which they always do, one needs to react fast and quickly. And so projects with weak governance structures often struggle as they tend to make decisions too slowly. The role of the lender's technical advisor. The importance of selecting a strong LTA should not be underestimated. The LTA is really relied upon to provide independent sort of oversight to lenders on construction progress and emerging issues. And this becomes increasingly important during difficult periods. Lenders often make credit decisions that are also based on advice it receives from the LTA, and hence the strength of the LTA becomes very important. And this doesn't only apply to the lender's technical advisor, it also applies to other lenders' advisors, including the legal advisor as well. Real-time monitoring. So definitely a reality is that traditional monthly reporting cycles does lag site conditions materially sometimes, and by the time reports are constructed and issued and eventually received by lenders, construction may have shifted quite a bit. And so live reporting updates can greatly assist lenders to identify issues earlier and to react faster. The goal is not to eliminate construction risk completely. It is rather to prevent manageable risks from becoming critical issues. Contingency management. Close attention is paid to the level of contingency utilization as well as variation orders. Variation orders cumulatively can become quite significant if not managed closely. In project finance, construction risk is never fully transferred. It is just continuously managed. Financial close to COD transition. The point is that a project could look perfectly bankable on paper, but construction execution is ultimately what determines whether the project succeeds or not. Construction risk. The reality is projects are exposed to contractor performance, delays, interface risks, logistic challenges, etc. And in wind projects specifically, delays can have a cascading effect. Contract structure. Bankability does not guarantee deliverability. You can have a well-negotiated contract, but ultimately you are relying on people, operational capability, and the ability of teams to make good decisions under pressure. We talked earlier about this, contractor strength. Particular attention is paid to the technical expertise, the financial standpoint, and equally important, the ability to deliver locally. Practicalities around mobilization. Simple things like mobilization to site are important. Projects are affected by delays in issuance of, for example, work visas or work permits. And because construction programs can sometimes be quite tightly sequenced, mobilization delays does have the potential to create knock-on effects on the overall schedule. Logistics constraints. Wind projects do introduce a unique logistic challenges because of the oversized nature of the components, as well as the fact that wind sites are quite remote. So transportation routes, road upgrades are also critical. Delays in logistics planning can also impact overall construction schedule. Path to COD. What we've found is that projects which escalate issues quickly, identify them quickly, and respond timeously are the projects that ultimately perform the best. At all times, sponsors, contractors, lenders, advisors all need to remain aligned. Ultimately, the period to COD determines whether success is achieved or not. And this brings me to the final slide, some of the lessons learned from wind project execution in South Africa. I think certainly the market has learned some very hard lessons in the wind execution in SA, but there are certainly a number of aspects which can assist to alleviate some of this execution risk. Spoke about it earlier, strong sponsor oversight and execution governance. Regardless of the strength of the contractor, from technical standpoint, the contracting strategy chosen, whether that's split or fully wrapped, strong sponsor support is absolutely critical. Continuity of teams between financial close and construction execution, and this point applies both to the sponsor team as well as the contracting team. There needs to be some form of continuity between teams, because if there isn't, then this creates knowledge gaps, which can be problematic. We talked earlier about practicalities around mobilization of foreigners to site, which also needs to be managed quite closely. And then more recently, we've also seen how fragile the local contracting market is and why enhanced DD is so important in that regard. Lastly, but not least, another very important aspect which must be managed throughout the project life cycle is close coordination with Eskom. It must be managed throughout design, commissioning, and energization on a consistent basis. And that brings me to the end of the presentation. I hope that was useful. Thank you.
Thank you so much. Thank you so much, Ms. Govender, for that insightful presentation. I do believe it provided valuable perspective as well as key takeaways for our audience, especially highlighting how construction execution remains one of the most significant challenges facing wind projects in the country, and also why governance structures and active oversight continue to be essential for successful project delivery. So thank you so much. Just a quick reminder to our audience that you are welcome to submit questions through our chat or our Q&A function, and then we'll try to get through as many as possible questions during our Q&A session. Moving over to our next speaker. Can you just confirm if I'm still sharing my slide? Let me just reshare.
We can see it now.
Okay, thanks, Santosh. So yes, our next speaker is Miss Megan Jarvis, who is a partner at Wentzel, and briefly I'll just read her bio. So Megan Jarvis specializes in commercial and corporate law, including mergers and acquisitions, joint ventures, Black economic empowerment transactions and rationalizations, with a focus on clients in the mining and construction industries. Her experience extends to cross-border transactions as well as project management. She has substantial experience in mining infrastructure, construction and power projects, including wind and solar projects in the Southern Africa. Her expertise has been recognized by Legal 500 and Who's Who Legal. So now Megan has a BA and LLB degree, the latter with highest honors from the University of KwaZulu-Natal. She also has a postgraduate diploma in maritime law from the same institution, and an LLM from the University of South Africa. And she is also rather an admitted conveyancer. And then so Megan, thank you so much for joining us, and over to you for your presentation. Thank you.
Thank you. Let me just share my slides.
Yes, please.
Can you see them?
Yes. We can see it.
Okay, so I'm going to be talking about managing EPC and multi-contracting risk in renewable energy construction. I'm going to talk about contractual allocation of construction risk, a little bit about retention and performance bond basics, dispute avoidance and risk containment, and then some final comments on construction governance, bankability, insurance, and you've heard from Standard Bank on lender requirements, so I won't spend too much time on that. So obviously what's critical in terms of construction contracts is essentially it's a framework for the contractual allocation of construction risk. And it's important to understand why construction risk matters in renewable projects. So renewable energy projects, solar, wind, battery storage, hybrid, obviously involve complex capital intensive construction phases with bespoke technical and commercial risk profiles. Construction risk, however, is the single largest risk category during project development, and lenders, investors, and insurers will focus acutely on how it is allocated and managed. So the choice of your contracting structure will fundamentally shape who bears the cost overruns, delays, and defects, how your interface risk is managed between trades and disciplines, and whether the project is bankable and, of course, deliverable on your project finance terms. So getting your contractual risk allocation wrong can have material consequences, leading to things like cost blowouts, protracted disputes, loss of revenue, and possibly project finance defaults. So looking at your sort of construction triangle, you often have trade-off of time, cost, and quality. Time, obviously, late completion means revenue loss and additional costs. Cost, contractor claims need to be funded, which will affect your project economics. And if there's a loss of quality, defects mean revenue loss and additional cost. So it's very important to obviously manage these aspects under your contractual regime and to ensure that your risk is properly allocated. Having a look at your EPC versus multi-contracting, obviously that's a fundamental choice that needs to be made. This slide essentially just summarizes some of the differences between the two regimes. Essentially, your EPC contract provides risk transfer, usually at a premium, and your multi-contracting option can offer flexibility, but may expose the owners and lenders to additional interface and coordination risk. Not going to spend too much time on this because I'm sure everybody's familiar with your EPC contract. Essentially, this is your single contractor, single contract model, usually known as a full wrap model. Your contractor carries out the engineering, procurement, and construction and essentially delivers a fully equipped facility that's ready for operation at the turn of the key. There's a high degree of certainty with regard to price and time, less involvement from your employer, and your contractor takes total responsibility. However, it's also important to remember that even a full wrap contract might not necessarily always be a wrap. Important to note your contractual carve-outs that may undermine your wrap, some of the usual ones being aspects like force majeure, your liability caps where your developer will then bear the risk in respect of a shortfall, and obviously weak creditworthiness of your contracting party may be a risk to your full wrap position. So essentially under your EPC structure, your risk allocation, the EPC promises that your contractor undertakes to design, procure, and construct the facility to an agreed specification and output standard for a fixed price by a fixed date. Your core risk transfers to your contractor are essentially design adequacy and fitness for purpose, which is obviously subject to your employer requirements. Procurement risk, supply chain, lead times, equipment specification, construction execution risk, aspects like labor, materials, sequencing, weather subject to your force majeure carve-outs, performance risk, aspects like capacity, efficiency, and output guarantees come into play here, and cost overrun risk subject to variation and your compensation event mechanisms. Your typical carve-outs for your owner's retained risk are things like ground conditions beyond an agreed baseline, permitting and grid connection delays, force majeure or exceptional weather events, owner-caused delays and variations, and changes in law after a specified date. Multi-contracting, the important thing here is essentially managing your interface risk. What is the interface risk? That's obviously the risk that gaps, overlaps, or failures in coordination between your separate contractors cause delay, defects, or additional cost, and no single contractor is responsible. You obviously have common multi-contract structures in your renewable space where you may have your civil balance of plant BOP contract, plus an equipment supply for your PV models, turbines, or BESS, plus electrical, plus commissioning, which may be separately or worked in various combinations. The owner generally appoints the owner's engineer or may also appoint an EPCM contractor to manage these interfaces. There are various mechanisms available to manage interface risks. These can be managed by interface agreements, which create binding obligations on each of the contractors regarding handoff milestones, access, and coordination. Scope or matrix or your responsibility matrix becomes important to clearly assign every scope or item to a named contractor. Your commissioning protocol is critical. It's often useful to have a single document which governs your sequencing and handoff of your various systems. Step-in rights can also be used to manage your interface risk, where your owner can step in at contractor's cost if interface failures occur. And liquidated damages regimes are also tools to manage your risk, but they must be carefully collaborated in your multi-contract projects to avoid gaps in LD coverage where one contractor's delay cascades to another. So choosing your contracting strategy that is linked with your financing. Project finance with no completion support may mean a lump sum, and low construction costs of multi-contract approach needs to be balanced against higher financing costs or equity support and your mitigations such as your PMC contracts or greater interface management. So I think as you heard from the first speaker, your split contract might not necessarily result in lower costs due to greater interface risk. And obviously it's very important that that interface risk is managed throughout your contractual period. This is just an example of a typical project structure. And of course, you have various alternate contracting structures that may take place. For example, your use of management contracting is something that we've seen where you have an appointment of a management contractor who procures work packages as the employer. You have limited pass-through liability, and again, this is different to your traditional EPCM and PMC arrangements. Risk allocation or managing risk can be done obviously through your choice of your payment models, and it's important to choose the most appropriate payment model for your contract type. You obviously have lump sum contracts, cost reimbursable, target cost pricing, a guaranteed maximum price, or provisional sums. It's important then to make provision in your contractual regime for payment provisions and remedies. So advance payments can secure cash flow benefit, but require adequate security. Where you have interim payments, lump sum payments may be typical for project finance. Progress payments may be made and milestone payments. It's important, obviously, to ensure that your scheduling is correct. Cash neutral or project negative gap, your S-curve may be subject to scrutiny by the LTA. Whether you have right of set-offs and what happens with respect to disputed payments needs to be carefully managed through your contractual regime, together with remedies for non-payment that may include payment of interest, suspension, and ultimately termination rights. So as I've said, there are different methods for determining your price, but whilst fixed price is most common for project management, it is not really fixed in that you, in your contractual regime, will have provisions for variations or changed orders from your owners or contractors. Force majeure, the debate there, whether the contractor is entitled to additional cost or just time, is a negotiation point. Change in law or other mandatory changes may also impact on price, as will delay your interfaces, particularly where those are not properly or appropriately managed, and there may be other accepted risks. So under your liability framework, contractor performance security is very important. As our first speaker also mentioned, your creditworthiness of your contractor entity is critical. And obviously where you have a consortium in a complex construction project, there is often a debate around liability, whether that is joint and several, and that needs to be appropriately regulated. Parent company guarantee, if your SPV is in breach, obviously that must be bankable and assignable to the lenders. Performance bonds, bank guarantees and letters of credit obviously need to be bankable and assignable. Performance bonds should be on demand. Your ratings downgrade of your issuer may be a project risk. Failure to renew a bond and increases on contract pricing may all impact on your security framework. Security obviously needs to extend to your defects liability period, and obviously your major subcontractor, there may be provision of a collateral warranty and also direct agreement in that regard with the lenders. Limitation of liability, obviously, as I have said, might mean that your full wrap is not necessarily a complete wrap. It's usual in your contractual framework to provide that there's no liability for consequential loss except for your PLDs or DLDs. These we see are generally capped or typically capped. Your PLDs at 10 to 20% of the contract price and your DLDs within a similar range. These are obviously critical for renewables, and loss of electricity revenue during delay or following a performance shortfall is typically indirect loss. So the owners need to negotiate specific carve-outs or recover via LDs or performance LDs. So your cap is generally market or sector driven. It is commonly 100% of your contract price, together with carve-outs that generally include things like willful default and gross negligence, your illegal and unlawful acts, rejection, breakage costs and reinstatement of your site. Liability under indemnities is generally uncapped, and usually your insurance recoveries are accepted. So your typical indemnities include third-party damage, injury and death, intellectual property indemnities, breach of laws, tax indemnities, anti-bribery and corruption, environmental damage. So your exclusions from your cap, obviously these are usually highly negotiated in your contracts, but the usual ones are, as I've said, for indemnities, fraud, willful misconduct, sums recovered under your insurance policies, abandonment of work, penalties imposed by government authorities, or obligation to complete works and remedy any defect or damage. Usually exclusion of consequential loss, and subcaps may be negotiated for delay and performance liquidated damages. So you have two types of liquidated damages: your delay liquidated damages, which relate to failure to complete certain contractual requirements by a due date, and your performance liquidated damages, which relate to failure to achieve specific performance or output. You need to ensure that these interact carefully with your insurance regime. The advantage of your LDs is that there's no requirement to prove causation of the breach or quantum of the loss suffered. It must be a genuine pre-estimate of loss and not a penalty. And generally there is no duty to mitigate your loss unless you've prescribed that. So what must the contractor achieve in terms of your performance? Quality throughout your project performance is obviously very important. It starts usually with your owner's specification, with the detail and which should be detailed and obviously correct. Prescribing of your key equipment. Your performance guarantee regime is critical, rights to inspect, and then your performance tests before takeover. So where there's prolonged failure, termination and rejection, remedies are built into your contractual framework. You need to have a mechanism for your passing of your tests, and you may have to pay PLDs or an abatement of the price where those tests are not wholly successful. Your defects liability period, also something that needs to be carefully managed throughout your contractual regime. The obligation to repair defects and damages or pay for damages needs to be regulated in your contract. Evergreen warranties and long stop dates need to be negotiated and agreed. And assignment of longer subcontractor warranties is important. Your latent defects liability period, obviously also important to deal with latent defects as they arise. So defects liability period, we as a standard see 12 to 24 months from practical completion. Your contractor is obliged to repair or replace defects at its own cost, and the defects liability period may occasionally be extended for repaired items. So you may have a rolling defects liability period. Performance warranties, obviously guaranteed capacity and energy performance, important in your contractual regime. Your performance testing at completion is critical in this regard, and your regime must specify your test protocols, irradiance conditions if we're dealing with solar, temperature corrections, consequences of testing failures, retesting rights, and the maximum number of retests. Equipment warranties become particularly relevant in your multi-contracting environment. Module inverter, turbines, best manufacturer warranties may be the primary protection for the owner. Your EPC contractor should pass through manufacturer warranties. There should be provision for novation or assignment of the warranties, and that again is often a key negotiation point. It's important to ensure that your warranty periods are bankable, and your lenders obviously will scrutinize the creditworthiness of the warrantor. And latent defects, some contracts provide additional protection for latent defects beyond the defects liability period, and it's important where defects may not manifest for several years, blade erosion, PV module degradation being examples of aspects that may be covered by a latent defects regime. Your retention and performance bond basics, essentially a retention is a percentage, typically 5 to 10%, that's withheld from your progress payment as security for your contractor's obligations, primarily defects rectifications, and it may be released in two tranches. Typically, your first release may be 50% on practical completion or system acceptance, and your second release is typically on the expiry of your defects liability period. Key negotiation points, your retention cap, what is the maximum amount that is to be withheld, whether retention can be substituted by a retention bond. That may be common for large EPC contractors who wish to improve cash flow. Whether your retention is to be held in a ring-fenced account, which may provide some insolvency protection and may be important for the owner, and how retention interacts with your LD set-off. In the South African context, we commonly see retention arrangements under your FIDIC-based and JBCC contracts, and you may also give consideration of your construction guarantees under your CIDB regulations where applicable. I won't spend too much time on this, but this is just an example of a configuration of bonds which provide security for liquidated damages. You've got an advance payment bond, which starts off at 20% of the contract price at the start and is reduced to 10% at completion or takeoff. Your retention bond, your performance bond, and your step down during your defects liability period. I think I've covered quite a lot of this, but in terms of your sort of credit support, various mechanisms that are available to help manage risk during the project, with parent company guarantees, advance payments, bonds, your performance bond, retention amounts, warranty guarantees, additional security for equipment removed from site, to be linked to the payment profile and your milestones within your contractual regime to ensure that the credit risk is covered in relation to the project. I've spoken briefly about performance bonds, the interaction with other security. Your performance bond and retention constitutes a layered security arrangement. It's important to ensure that the project is bankable from a financial perspective. Common pitfalls or risks that may need to be managed during the project is where bonds are issued by non-rated local insurers. Generally, this is unacceptable to the lenders, so you might not even pass go. Bond expiry date needs to be aligned to contractual, where it's aligned to contractual completion and not actual completion is a gap that we often see, so that needs to be carefully considered and managed during your contractual regime to ensure that your bond expires on actual completion. And the bond terms need to be consistent with the underlying contract. Another pitfall that is commonly seen is where there's inconsistency, for example, with regard to caps or governing law. Lender security, so ordinarily a direct agreement between the contractor and lender's agent, providing for perfection of security, step-in rights, suspension of termination and cure rights, substitution and enforcement of lender security, and payment of DLDs and PLDs into closed accounts may be required. We've spoken about the configuration of bonds. So why are construction claims inevitable? So renewable energy projects obviously involve a complex interface between your engineering, procurement, logistics, civils, and electrical works, and your scope for genuine disagreement is high. And what's important is how these are actually managed throughout your contractual period. So claims commonly arise from variations or change orders due to a change in scope, design, or specifications. extension of time for delay events, loss and expense or additional claims costs, employer-caused delay, ground conditions, or force majeure. So claims management is a risk tool. Early identification and resolution of the claims reduce the risk of disputes crystallizing into arbitration. Proactive contract administration is required, giving of notices, keeping of records, issuing of site instructions, and the management of that process is essential throughout the lifestyle of your life cycle of your contract. Failure to give timely notice is a common cause of time bars. Obviously, your FIDIC-based contracts impose strict notice periods, and a time bar provision means that failure to give notice within that period may extinguish the claim, which is a significant risk in your fast-moving construction environments, and owners should equally comply with notice obligations to avoid waiving rights. So time delay obviously impacts on your project economics. They reduce income source, they may increase costs, and they may incur penalties. Your right to receive extensions of time is important, and I've listed some of those events that may give rise to those EOT claims. Also important just to remember your sort of your prevention principle. So in construction contracts, an employer's active prevention, which could either be a breach of a contract, such as a failure to give access to site or a delay in issuing drawings, or a valid action, for example, instructing the contractor to perform additional works or to suspend the works. So in either case, if the contract does not provide for how the delay is to be dealt with, the employer will not be required to entitle the contract to complete the works by the original contract deadline, and there will be no means in the contract for fixing a revised date. So in such circumstances, your original contractual deadline falls away and time becomes at large, where the contractor is only required to complete the works within a reasonable period of time. And obviously, that arises from the fact that in law, a party may not enforce a contractual obligation against another party where it has prevented the other party from performing the obligation. So it's very important to actually structure and draft your contracts correctly to try and avoid the at-large time becoming at large and resulting in the works having to be completed within a reasonable period of time only. Sorry. Oops, I'm going the wrong way. Sorry, my mouse is not working. I'm just going to stop sharing and share again. Give me a minute.
Okay. Okay, no problem.
I don't know why.
You can see it now. It's back.
Thanks. Okay. So contractor underperformance, remedies and risk containment. So early warning signs are obviously important. These include failure to mobilize in time or adequately resource the works. Program slippage beyond agreed tolerances needs to be managed and dealt with. Quality defects identified during construction. Subcontractor insolvency or non-payment cascading to site disruption. and financial distress are all early warning signs of contractual underperformance, which may need to be managed within your contractual framework. So contractual tools for managing underperformance include tools like early warning or escalation notices, where you have formal written notices requiring your contractor to remedy with specified response times, remedial plans or recovery programs, which your contractor may be obliged to submit and implement a revised program showing return to the completion date. Step-in rights, where the owner may step into subcontracts, or you may also have circumstances where your lenders are entitled to step in. Termination for cause, this is typically a last resort, which will require careful compliance with contractual preconditions, and typically only after repeated failure after notice or contractor insolvency. Calling on performance bonds should be considered in parallel with termination for cause. And acceleration, where your owner may instruct or your contractor may elect to accelerate. Your cost allocation may depend on who actually caused the delay. Termination risk, obviously when a decision is made to terminate, that is, as I've said, something that is ordinarily only used as a last resort, but wrongful termination may expose or will expose the owner to significant liability. So taking legal advice before terminating and terminating in accordance with the provisions of the contractual framework is critical. And termination for convenience, that's often a negotiation point as to whether that is to be included in a contractual framework, often hand in hand with an agreed compensation formula. Dispute avoidance mechanisms, it's usual in your contractual framework to provide for an adjudication board. FIDIC 2017 obviously has your DAAB. You have a permanent board appointed at contract commencement. Regular site visits are important, where the board will develop project knowledge. They issue binding decisions under your FIDIC regime, if that's your contractual framework, within an 84-day period, which are interim binding orders enforceable immediately, and that these sort of dispute avoidance mechanisms are generally recommended for large EPC contracts. Expert determination, another mechanism for a dispute avoidance, where you have an independent technical expert appointed to resolve specific technical disputes, faster and cheaper than arbitration for technical issues. Senior management escalation, tiered dispute resolution from site level to your project director to your C-suite escalation is typical, with cooling off periods before formal dispute resolution. It is usually effective for commercial disputes, but may be less effective for your technical disputes, which are better suited to expert determination. And mediation, non-binding, but may be effective or particularly valuable mid-project where relationship preservation matters. Termination, usually employer termination events will be things like insolvency, prolonged delay measured against your LD cap, material breach, or when minimum performance guarantees are not achieved, and contractor termination, usually for general breaches not acceptable, non-payment, prolonged suspension, generally except for the fault of the contractor, and whether the contractor has a right to terminate for prolonged force majeure is also often hotly debated. Termination, compensation, important to evaluate the additional cost to complete against the right to reject and the ability to recover losses and the contract price. I don't think I need to cover this in too much detail, because I think a lot of what is bankable was covered by our sort of first speaker. I have mentioned also your direct agreement and lender step-in rights, which are typically provided for in your contractual framework. Construction insurance, perhaps just finally, key cover is obviously a sort of key mitigant for risk under your contractual regime, the principle being that the party who's best suited to manage the risks could take out that insurance. And obviously your insurance regime needs to sort of talk to your cap on liabilities, etc. Construction governance, so linking your contracts to your lender requirements, your EPC loan agreements, your LD regime should cover your cost of your debt servicing during delay, and your completion date should align with your long stop date in your loan agreement. EPC contract and your PPA, your COD date under the PPA must align with your EPC contract completion date, and the PPA long stop termination rights should be later than your EPC long stop date. Your EPC and insurance, your car deductibles, exclusions, and insured value should be coordinated, and gaps between what the EPC contract requires and what is insurable should be identified and assessed early. And your EPC contract and grid connection, your grid connection agreement obligations, commissioning windows, metering acceptance must be reflected in the EPC contract program milestones. Some key risk management principles. I think this is just a summary of what I've been talking about to match the contracting structure to the project's risk profile and financing requirements. Treat bankability as a design constraint, manage the interfaces, coordinate the entire contract suite, layer your security, design the LD regime carefully, and invest in dispute avoidance mechanisms. I have included here, but I'm not going to cover this today because it was outside of the scope, and I think I've used up my allotted time, but I have included some slides for information on O&M structuring in your project documents. Obviously, that's also very important in the success of your project as a whole, but I don't think there's a need for me to go through that today, and so that brings me to the end of my presentation.
Thank you very much, Ms. Megan Jarvis, for your great presentation. And now I think without wasting time, we will move and open the floor for our Q&A session. I think before I hand over to my colleague Santosh, I just have two questions for our speakers. For Ms. Govender, you mentioned during your presentation the importance of having strong governance structures for successful project delivery. And my question is, what is one governance practice that most improves the project's chances of reaching COD successfully? And then the second one would be, what would make lenders more comfortable in terms of financing either split EPC or multi-contracting models? And then for Ms. Jarvis, from a legal perspective, what is one contractual provision developers often underestimate but later causes major disputes or delays? As you note those down, I'm just going to hand over to Santosh, and then we'll follow his direction in terms of our questions on our function of the Q&A. Over to you, Santosh. Thank you.
Thank you, Callan. I think we'll open, before I introduce additional questions, I'll open to Ms. Govender to answer your first two. Yep.
Thanks, Talent. Just in terms of the first question on governance, I think what is absolutely critical, and it was kind of a theme that came through in what I was presenting on, is having a sponsor team that is completely coordinated, stays close to issues on the ground, works together with lenders. You know, it's about it's about sharing updates or issues as they come up rather than 2 months later when the issue is escalated. So it's that kind of thing, being very proactive and managing construction, because ultimately construction issues always do occur, and it's to do with how proactive are you with managing it and responding quickly and working together with the lenders, because ultimately lenders and sponsors are partners in the project. Our interests are aligned, and really we want the project to succeed. I think in terms of the split versus fully wrapped contract, it's not necessarily that lenders are uncomfortable with split EPC contracts. It is certainly more common than not. The point is just that there are certain factors. So there's a cost benefit analysis that you must undertake. For example, split contracts come with a cost benefit, procurement flexibility, etc. But there's also interface risk that this presents. And so it's important to manage that interface risk. I hope that answers your questions, Talent.
Yes, definitely. Thank you so much. Over to you, Santosh.
Thank you. I think let's head straight to Ms. Jarvis to answer your second question.
Sorry, can you just repeat what that question was again?
I was saying from a legal perspective, what is the one contractual provision developers often underestimate but later causes major disputes or delays?
That's a difficult one. I think your force majeure clauses are always a clause that's sort of hotly negotiated. I think a contractual regime where things cause delays that are unexpected, it's when one is caught completely off guard by something like COVID, etc. When COVID hit, for example, we saw that there were a number of contractual frameworks that had either not included force majeure clauses, or the force majeure clauses did not specifically cater for things like epidemics and pandemics. So we saw lots of claims that were unexpected, and consequences of those claims. For example, the additional costs incurred in having to secure appropriate sort of PPE for workers, and then of course the delays where workers were perhaps not allowed on site at all due to sort of hard lockdowns. Things quickly developed then, and then of course it's now common to see your FM clauses containing reference to epidemics and pandemics. I don't think it's necessarily the contractual framework per se that results in claims. I think where we see disruption occurring in the construction arena, that is often due to events within the South African context, like the construction mafia, for example, still remains a very thorny and tricky issue to try and manage, where we still see things like agitation on site, which ultimately affects those sorts of projects. And whilst the contractual framework tries very carefully to sort of allocate your risk, usually your contractor has to manage that risk, we are seeing quite a lot of pushback from contractors who say that there are just certain risks that it becomes almost impossible for them to manage, and that maybe those should more appropriately be borne at a developer or sponsor level.
Okay, thank you so much. I think it's clear from my side. Thanks.
Thank you so
over
much,
to you.
Ms. Thank you, Talent. Thank you so much, Ms. Jarvis. I'm going to alternate the questions between the two speakers. So we'll go to the first question from Lafika Sindane, addressed to Ms. Govender. You mentioned draw profiles, liquidity buffers, and lender oversight during construction. From a lender's point of view, what matters more before commissioning? Having enough contingency funding or other liquidity buffers available, or having strong oversight to spot the issues early on before they delay COD or affect the debt case?
Thanks, Antosh. So it's everything, actually. So really, you want to evaluate the robustness of your cash flows under various stress case scenarios to ensure that there is the cash flows are robust enough to withstand stress case scenarios, because ultimately anything could happen in construction, and the idea is to ensure that the business case stacks up even in a stress environment, as well as contingency and as well as strong sponsor oversight. All these factors are key.
Perfect. Thank you so much. Then the next one is again for you, Ms. Govender. So how has lenders' assessment of social and community risk in construction evolved over time? What has been the lender's approach to private offtake projects where social risk management is not necessarily embedded in PPAs as they are in REAP projects?
Thanks. So certainly in the private market, it is not as focused as it is in the REAP sector. However, it does exist. I guess the extent to which it exists is different. In any case, as part of IFC performance standards and equator principles, the social aspect is certainly addressed under the financing. And it's also important to manage social risk, because if it's unmanaged, it does become ultimately a credit risk, which we want to reduce ultimately.
Perfect. Thank you so much. I hope that answers your question, Zakia. And then back to Ms. Jarvis now for land consents. So how are the land consent risks in the context of Section 53 issues from mineral and oil and gas holders for potentially going back on agreements, not engaging, increasing prices, taken into account in the risk allocation or mitigation process?
So essentially, in relation to the land consent, that is a risk that should be borne by the owner, and the contractual risk allocation should make that clear. If the relevant land consents have not been obtained, then that risk should actually be borne by the owner, and the contractor should be entitled to an extension of time and additional cost to the extent that it impacts on the construction activities. So it's very important in terms of the consent regime to clearly indicate what consents need to be obtained by which party and what consents need to be maintained by each party during the course of the project. And that should be an owner responsibility where they bear the risk.
Thank you so much, Ms. Jarvis. Then back to Ms. Govender again. So talking about the issue of small businesses. So how do banks or lenders allow for the participation of small businesses to eventually participate as the primary contractor, noting the requirements for track record and experience?
Sure, thank you. So absolutely, banks definitely do have appetite to support SMEs, and there's 100% appetite for that. Just from what we've seen in the market, if, for example, one is looking at construction of a 200 megawatt wind project, for example, what lenders typically do want to see is a track record and experience in executing this. What we've seen is that SMEs are integrated in the contracting structure through subcontracting. That's what we've seen. And I think it's just important to make the point that every project is totally different, and it really depends also on the project itself.
Thank you so much. And another one for yourself, Ms. Govender. Ms. Jarvis already spoke about the construction mafia risk. So what's the what processes do the banks or lenders have in place to mitigate that construction mafia risk, or is it classified as part of the general labor or project risk?
Sure. So it's certainly a risk that exists. It is a risk that credit committees are alive to, and it is highlighted as something that must be managed and understood pre-FC and on a continuous basis. And we do this by staying close to our clients on the ground, having conversations with the contractors on the ground. So it is certainly a focal point that all parties pay specific attention to.
Thank you, Ms. Govender. The next question we have is from Asante Piri. I'm not sure who this is directed to. I assume Ms. Jarvis. What does the lender's final evaluation process actually look like? Is it primarily a checklist or tick box assessment against all requirements, or is it more of a weighted scoring model with a minimum threshold for a go, no-go decision? Oh, sorry, that would be then to Ms. Govender, sorry.
Sure, thank you. So I wouldn't say it's a checklist or tick box assessment. Certainly, there are certain DD work streams that must be undertaken to get to a decision of whether we want to fund the project or not, both on the environmental side, technical, legal, as well as financial. So it encompasses a very intense due diligence process that is undertaken pre-credit committee. And I think the point is by the time one gets to credit, we have a great understanding of whether this project will go ahead or not. So it's an enhanced level of due diligence. And it's also linked to strategy, appetite, etc.
So much. Then the next question is from Claretta Slater for both speakers, though we'll start with Ms. Jarvis to respond. How has the aspect of limited grid availability impacted on lending and contract structuring, if any impact at all?
I think limited grid availability has directed where renewable projects are likely to be advanced and where they are not. So, you know, Northern Cape, for example, we're not really seeing too many new projects there due to grid constraints. Primarily, we've seen developments in other areas like in Mpumalanga with wind farms there, the Seriti's project there, for example. I haven't seen too many impacts on the contract structuring itself, where the contractual aspects are important is in terms of your testing and taking over regime, making sure that the time periods for that are clearly set out and defined, and that there is an appropriate allocation of risk where that grid connection is delayed, ordinarily that being a sort of owner/developer risk. Does that answer the question?
I think that's fine for now. Thank you so much.
Thanks.
Ms. Govender?
Sure, I think Megan has answered, but I guess the point is you need grid connection to have a project. And so if there's no connection, unfortunately, there's not really going to be lending to the project. It is a challenge, and it's certainly a challenge. There's an abundance of wind sites, but the grid availability is certainly an issue at the moment.
Thank you so much. And then I'm going to end with a sort of a more philosophical question, since I think this is a application for South Africa Inc. as a whole. So on that same grid risk, how are the lenders and the contract managers and the legal advisors supporting government to mitigate these sorts of risks, such as in the implementation of ITPs, progress of TDP, etc.?
Thanks, Santosh. So 100% RTP is critical to unlocking some of these constraints. And Standard Bank, we are closely involved with government as well as key industry stakeholders on the program. And we are following the process and yeah, we're really looking forward to that process kicking off and developing.
And a very similar answer from a legal perspective. We obviously also stay close to government, and I do have colleagues of mine, particularly in the public law and regulatory space, who advise government on various of these issues. I think from a philosophical perspective, we accept that there really does need to be, or do need to be, public-private sort of partnerships. Government needs to work hand in hand with the private sector. Obviously, the financiers form an important part of any project sort of structure, and the intention is really to try and cooperate to ensure that projects can be delivered that benefit South Africa as a whole.
Thank you so much for those commitments, and I think we need to see those collaborations in order to move forward together. That's all from the Q&A part on my part. I see Talent has submitted an additional question to Ms. Jarvis. So in practice, where do you see the contractual failures occur between risk allocation, interface management, or performance guarantees?
I think the starting point is obviously having a decent contractual framework. So obviously, if you don't have an appropriate contractual framework where risk is appropriately allocated generally to the person who's, or party who's best placed to manage it, that is the first failure. However, I think in practice, generally the contractual framework is probably in good enough shape. The majority of risks and failures in construction projects come from implementation of those projects, and a lot of those problems might arise due to interface gaps. Obviously, those interface gaps will be exacerbated if there's not an appropriate contractual regime dealing appropriately with interface risk, because things can then fall between two stools. But also, the more parties one has to manage, the greater the risk is of disputes. There's just more ability for things to go wrong, and for different parties to be pointing fingers at one another, as opposed to where you have a single interface. But generally, I think it's in the implementation, and then if your contractual framework is not properly followed, so you have a problem that arises, it's not dealt with appropriately at the time, there isn't an early warning regime, or steps are not taken when those issues first arise.
Thank you, Megan. I think that's quite clear. And apologies, I see there was an additional question submitted while we were rounding out. So firstly, a clarification from Asante to Ms. Govender. Apologies, I did not mean to trivialize the DD process. My question was more around understanding the decision-making process once the due diligence has been completed and the risks are known specifically, how the lender ultimately determines a go, no-go outcome on one project versus another. And a final question for you, Ms. Govender, before I hand back to Talent. What is the lender's view on quote-unquote uncontracted energy? For example, the wind project is 300 megawatts and the PPA is for 250 megawatts. Can the 50 megawatts be uncontracted?
Thank you. So absolutely sure. I guess the question is more directed around what does the governance process look like? And I hope I'm understanding the question correctly. So each bank is different, but at Standard Bank, we have a 2-level approval credit type process, the first being an initial screening. And at the screening, it consists of various members from the business and sector teams as well as risk. And at this stage, even though it's the first level credit approval, there is confidence in knowing whether we will get a final credit outcome, a yes at final credit. And so there's quite a bit of certainty at that stage. Of course, it's subject to unpacking the DD and understanding the credit risks during the DD phase, which needs to happen pre-final credit committee. I hope that answers the question. And then just on the question on uncontracted versus contracted capacity, that's a bit of a tough one. But I guess just in terms of project finance, really what we're concerned with is understanding certainty of cash flows. We want certainty of cash flows to ensure that debt is repaid when it needs to be repaid. So so if I could answer it in that context, and it really does depend, I think, on the project itself. And I don't want to say, for example, 50 megawatts uncontracted, for example, is something that would work. I think it depends on the project. It depends on the financial model. It depends on the level of gearing and the financing structure encompassed in that project. I hope that answers the question, Santosh. Thank you.
Thank you, Ms. Govender. And I suppose that will tie into what the rules are surrounding participation in the wholesale electricity market going forward, and whether
Absolutely.
that 50 megawatts can be allocated for trading there.
Absolutely, exactly. And we're also looking forward to seeing how that evolves over time as well.
Mm-hmm.
Perfect. Thank you so much. And back to Talent.
Thank you so much, Santosh. And let bring us to the end of our great session. I myself have learned a lot. So I would like to extend a sincere thank you to our speakers, from Ms. Govender coming from Standard Bank and Ms. Jarvis from Weber Wentzel, for sharing your valued expertise, insights, as well as industry perspective. And then also thank you everyone who have joined us online and contributed to the discussions through our Q&A session. We hope today's session offered useful insights into the key considerations that are involved in moving projects from contract to commissioning. And then also just a reminder that the webinar marks another part of our From Concept to Closure series, and we look forward to continued conversations in the upcoming session. As I mentioned earlier, part 3 of our series will take place on the 26th of May, and we encourage everyone who's in this call to join us as we explore the next stages of the project life cycle. And so from myself and the SAWEA team, once again, I would like to thank you for your time and participation, and see you again in part 3. Have a great day. Goodbye. Thank you, everyone.
Thanks. Bye.
Thank you. Bye. Bye. Bye.
Thank you. Bye.
Bye.